Europe's largest economy should just skirt recession this year. That's according to a new expert assessment. The government's Council of Economic Experts now saying the economy will grow 0.2% this year due to a more stable energy supply. German efforts to replace Russian energy exports have gone better than expected, with market prices falling from last summer's highs. And the ongoing global banking crisis is not a threat to Germany's economy. That's according to the forecast. Monika Schnitzer is chair of the German Council of Economic Experts, which released that forecast, and she joins me now. Ms. Schnitzer, welcome to the show. You released, if I'm right, I think 40-page report, this update to an assessment that you gave last fall. Can you summarize for us, as briefly as possible, how would you describe the state of Europe's largest economy right now?
Well, we really benefited from the mild winter and the increasing supply of alternative supplies of energy, in particular LNG imports. This has brought energy prices down, and we are benefiting from that. We also benefit from the effect that China has stopped its zero-COVID policy. So that has lightened up the prospects for exports a bit, and also it has eased the supply chain problems that German manufacturers experience for a long time. So in a nutshell, the outlook has brightened, but only a little bit, because what still is a huge problem is inflation. This decreases purchasing power. The wages have not kept up with inflation so far. And so this is really dampening the economy, as well as the interest rates that have increased because of the ECB's policy, of course, to dampen inflation. This also is a problem for investments.
Many experts have called this sticky inflation. That is, the general trend may be downwards, but it's hard to assess where exactly it's moving, how fast it's moving. Do you feel like you have a good picture of where interest rates are going? Does anyone have a good picture right now, given this kind of up and down that we're seeing with inflation?
Well, we expect inflation to come down over the year, but this will be helped by the interest rate increases that the ECB has imposed. Now, with the current upheaval in financial markets, of course, there is some demand to perhaps not increase interest rate as much anymore, or perhaps to postpone it a bit. At the moment, we don't see that this will be really necessary. It's rather important to really fight inflation, because then the economy will grow up, will pick up growth, and that is what we expect for the next year.
Speaking of inflation, we've seen a lot more labor union strikes over the past year because of inflation, because of a fall in real wages. You mentioned that in your report. To what extent are we seeing a significant relationship between higher wage demands and rising prices, this so-called wage price spiral?
Well, we have not seen this wage price spiral because the unions have been, in fact, really moderate with their wage demands. I mean, yes, of course, they go on strike and they ask for more for the next years because they have a lot of catching up to do. The real wages have really decreased over the last 2 years. And so that is understandable. But exactly the point that wages have not increased so much yet is the reason why we don't see such a boost to inflation coming from wages.
Briefly, can we say that Germany is out of the woods when it comes to the worst-case scenarios we pictured last year?
At this point, it looks rather bright, but of course, the energy crisis is not over yet. We will still have to deal with the next winter. So that means we will have to fill up the gas supplies. This will again, most likely have a rather boosting effect on energy prices. So it will take another year or so before we have all the supplies that we need from alternative sources. And that means we are not really out of the woods yet, but at the moment things are looking okay.
All right, that's Monika Schnitzer, chair of the German Council of Economic Experts. Thank you.